Hello, welcome back. Here is Ali Talabi, and this is our second lesson from Module 9. So, as I promised in this module, I'm going to talk about the operating cash flow. And toward the end of this lesson, I will talk about the business taxes in Canada. So, if you live in Canada, if you're interested to know how this kind of taxing work, and for sure for the corporations, I'm going to talk about that. It's kind of different than what we have in the US and the rest of the world. We have something which is called CCA. So I'm going to talk about the CCA and how we use that actually to include the cash flows which are affected by the CCA rule in our calculation. So let's start our lesson. So I'm going to talk about the operating cash flow and how we actually measure it. Just a few notes before just showing you the formula to calculate the operating cash flow. Remember, when you're investing in a project, it might impact on revenues or expenses or both. So remember, in some projects are kind of cost saving projects. So maybe they don't increase their revenues, but they can reduce your expenses or costs by a specific amount. Still, those projects can generate positive cash flow. Why? Because we talk about the incremental cash flow and we are interested to see how the project is affecting our cash flow. So reduction the cost, it means the kind of cash flows because you are reducing the cash outflow, and reduction cash outflow is equivalent to the cash inflow. So the whole argument here is just be careful how you interpret the numbers. The goal here is just to look at the project, which at the end of the day, they provide you positive net present value as we learned in module 8. One of the major differences we learned in the previous lesson between the cash flow and the net income is that actually in the cash flow we are more concerned about the cash and how cash is coming or going. And one of the major components which determines that kind of cash is depreciation. Why? Because when it comes to accounting, when it comes to net income or net profit, we include depreciation as a type of expense. But we know depreciation is a non-cash expense and shouldn't be deducted when we calculate the cash flow. So we are adding back depreciation to our calculation. That's one of the major adjustments we are doing to the net income to generate the depreciation. Now, let's talk about operating cash flow and how we calculate that. So there are several ways we can actually calculate the cash flow. And as I mentioned, the major component of cash flow calculation is to adjust for depreciation. And the way we can adjust the depreciation is a kind of different. But at the end of the day, whatever method you choose, the result, the cash flow should be same. Here I'm going to introduce you two different approaches. The first one is the adjustment to the net income or the net profit. So what you do, just you simply add back depreciation to your net profit and you can calculate the operating cash flow. The second approach is a bit more complicated. However, given the information or the data you have, you can use this method. Sometimes you don't have the net income. You don't know what is the net income, but you know your expenses, you know the revenues, so you need to start from scratch. So the second approach is more detailed one. And here is just the revenue minus cash expenses, and then you're taking out the taxes and you're adding back not the depreciation, you're adding back depreciation times the tax. Here, look at this example. You have the project which generates $1,000, the cash expense is $600, and depreciation of $200. Let's assume the tax rate 35%. So we can calculate the tax. In this case, it's $70 tax you are paying. So if you use this first approach, you are adding back the depreciation. So what is your net profit here? So the net profit is simply $1,000 minus, so let me write it down, minus $600 minus $200 minus $70 taxes you are paying. So you can calculate the net profit, which is $130. So that's your net profit. Now you're adding back $200 to that net profit you calculated, so your cash flow from operation is $330. The second approach, what we do, we just include, we start from scratch, we include the revenues and cash expenses, we deduct, take out the impact of tax, and we are adding back depreciation times tax, the tax rate. And in this case, it will give you the same $330. Actually, both approaches are equivalent, so it doesn't matter which approach you're using. The second method is rewriting the previous formula. So if you, that's a kind of matter of just rearrangement and recalculation. You will see that you can go from the first to the second, or from the second to the first method, and it will give you the same actually formula and the same number as we discussed. So we talk about the operating cash flow and how you can calculate the operating cash flows. And we mentioned that one of the major one of the major factors which actually determine the operating cash flow is depreciation. We know, we learn in accounting that there are several ways we can measure or calculate the depreciation. So the most common one is the straight line. So you just go with the book value, you take out the salvage, and you divide by the useful life. For each year, you get the same amount of depreciation. However, another approach is using declining balance. So what is the declining balance? We know that most of equipments, or most of machines, they actually, or long-lived assets, they usually, in the beginning years, the depreciation is higher, so they depreciate in a higher rate. However, over time, the depreciation is getting lower, so it's getting a smaller number. So decline balance is allocating higher depreciation for early years, and it reduces the depreciation over time. So CCA, which is very common in Canada, is very similar to declining balance. So CCA actually stands for capital cost allowance. So how it works, actually for different assets, for different classes of assets, we have a CCA rate, or the declining rate. So it might be 20%, 30%, 40%. So we use that rate, which are actually determined by the CRA, Capital Revenue Agency here, and based on those rates, we start just to depreciate the assets over time. However, there are some other rules which we have to follow, and I'm just going to talk about those rules as well. So one of the major rules is called half-year rule. What does it mean? It means only 1/2 of the purchase cost of the asset will be added to the asset class and used to compute CCA in the year of purchase. So for example, let's look at this example I have here. Let's say during 2018, just make it simple, in the beginning of 2018, you just acquired an asset, equipment for $1,000. When you are going to calculate the depreciation for this asset, just you include 50% or $500 of this asset in your CCA calculation. Maybe you say, Ali, why? This is one way just to avoid any misusing the CCA approach. Why? Because we know depreciation is one of those expenses which is acceptable by the CRA, so it will reduces your taxes, because depreciation expense higher, it means you will pay lower taxes. So some companies might be kind of motivated to acquire or buy many type of assets just to reduce the taxes they're paying. This applies just to the first year of purchase, so you cannot just buy all the assets the first year and then use depreciation, because just you need to consider 50% of the value. However, starting the second year, you can just apply the full value of the assets. So I'm just going to talk about this example in a second, but the first rule here is the half-year rule. Now, the second point here is when it comes to selling your asset, you have to be careful. So because we know there are some undepreciated part of the asset which is still in your account. However, whatever you sell might be greater or less than the UCC. Again, UCC, that's the undepreciated part of the asset, and the market price or the selling price might be more or less than this UCC. So you remember, you cannot take out more than UCC from your accounts. For example, if the UCC is $500 and you sell the asset by $700, you cannot reduce the value of the asset by $700. You have to just to take out the $500, which is the maximum UCC you have in your accounts. And finally, when you are selling the asset, remember that, as I mentioned, either you are selling more than the UCC or less than the UCC. If you're selling more than the UCC, we call that recaptured depreciation. So you will end up having a negative balance in your account. So recaptured depreciation, it means the sale of the asset is greater than the undepreciated part of the asset in your account. So you will have a gain on that. Or you might end up selling less than the UCC, which in this case we call that terminal loss. And for sure, for both cases, there will be some tax consequences. So next, I'm going to use the example to show you how actually we calculate the CCA and UCC. Okay, let's look at this example. Let's assume that you just acquired an asset which worth $1,000, so you paid $1,000 for that. This asset falls into the classes which you have to calculate 40% depreciation rate. So your CCA rate based on the CRA is 40%. So you have to actually depreciate 40% each year. So let's say you just acquired this asset in the beginning of 2018. For the next 3 years, you are going to calculate the CCA and UCC. Again, CCA is capital cost allowance, so that's the depreciation calculation, depreciation cost for each year, and UCC, that's the undepreciated part, which you carry over to the next year. So let's start with the first year, 2018. As we discussed, in the first year, you have to apply half-year rule. So it means you cannot include the whole $1,000. You have just to go with 50% of that, which is $500. So what is the CCA rate? 40%. $500 times 40%, it gives you, yes, you're right, $200. So the CCA becomes $200 in the first year. Again, I assume that you acquired this asset in the beginning of the year, so you don't need to adjust for the part of the year. UCC is the part which you haven't depreciated yet. So what was the original cost? $1,000, you're right. What is the CCA? $200. So at the end of the day, the undepreciated part becomes $800. So 1,000 minus $200. When it comes to the second year, the half-year rule is gone, so you don't need to apply that. So you start with $800 and you apply 40% to $800, which gives you $320. That's your CCA for the second year. How much was the UCC? 800 minus 320, it should be $480. That's the part which you haven't depreciated yet. And when it comes to the third year, again, you are applying 40%. 40% of $480. So let me calculate that. It gives you 192 to be exact. Minus the 480, $288, that's the UCC or undepreciated part. Remember, the UCC cannot go below the residual value. So if, for example, the residual value is $300, the UCC, you have to adjust it to $300. It cannot go below the residual value. Now, let's assume at the end of year 3, you just sold the asset by $300. So if you're selling $300, this is greater than the 288, which is the UCC. And as we discussed earlier, it means this is recaptured depreciation, so you are recognizing actually some gain here. However, you cannot take out more than $288 from the accounts. The maximum is as far as the UCC, even if you sell it more than 300. For sure, if you sell it less than 288, it will be terminal loss. I hope this helps. So maybe you say, Ali, why we are so concerned about this depreciation calculation, the CCA, UCC? The major reason is for the tax purposes. We know from the CRA perspective, and when you're talking about the tax, I'm talking about any type of government, any kind of country, the depreciation is acceptable for the tax purposes, which means it reduces the amount of the tax you are paying. In other words, the depreciation is working as a shield for you, yeah? So it protects you from paying higher taxes. That's why we call that the tax shield. The tax shield here means that the CCA reduces the amount of the tax you're paying. We have similar argument for the interest and debt. So the debt helps you to pay lower taxes, correct? So it also works as a tax shield. So maybe you are kind of interested to see what is the role or impact of depreciation or CCA on tax. So how much it actually reduces the amount of the tax. For sure, one way here is just to calculate the tax shield year by year. So what you can do, you can just consider the tax rate you are paying and the depreciation from the table, and then you say, okay, depreciation times the tax rate, I can find the tax shield. So tax rate again times the CCA, you can find the tax shield. However, if you're talking about many years and many different assets, it might be very confusing, time-taking, and tedious. So you don't like to get involved in that process. Instead, you can use the formula to calculate the present value of all these tax shields. So that's another way you can actually calculate the benefits of having this CCA and depreciation in your accounts and considering how much it helps you to reduce the taxes. So in this case, I encourage you to use this formula. That's the formula I mentioned. So this help you to calculate the present value of the CCA tax shield. It seems a bit long, but actually it's not that challenging. So if you have the cost of capital, how much you pay for that, the capital cost, if you have the CCA rate, the company's tax rate, the discount rate, and the salvage value, residual value of the asset, you can use this formula to find the present value of the CCA tax shield. Again, it helps you to find out how much having this depreciation in your account helps you to save taxes. That's it for today. Thank you very much. We'll wrap up this session in the next lesson, and I will talk about some questions. We'll review some major notes. So make sure that you watch the next video as well. Have a wonderful day. Here is Ali Talibi. Take care. Talk to you soon.